expect 2021 to be a much different investment year than prior years. The actions of the government and the Federal Reserve in response to the pandemic have strategically shifted markets, and we believe some important adjustments will be needed to address these concerns. A new portfolio strategy may be needed. Steve, thanks for joining us today to talk about the challenges we face ahead. What do you think is the biggest change as we recover and get COVID well behind us?
We face a challenge because the simple balance of stocks and bonds in a portfolio that has worked for nearly 4 decades may not work as well in the next few years. Since 1982, interest rates have fallen from a peak of 14% to a low of 0.3% in the spring of 2020. For the first time in many years, we expect interest rates to rise. That's bad for the bond market. We expect that 2021 will see a dramatic pickup in the economy as the vaccine is distributed and pent-up demand is released. Instead of the negative 3% decline in the economy, we should see 5% or even higher growth. We've not seen that level of growth, but maybe once in 10 years. This is leading to changes across the market. We are already seeing this lead to food product shortages and in some cases higher food prices. There's been a disruption in some supply chains that's impacting materials and goods. We'll see more energy costs as driving and travel pick up. There's also some pent-up demand for luxury stores. Home building, too, will continue to rise in some areas and lift lumber prices. This should all cause a temporary pickup in inflation. Markets will then drive interest rates higher. The 10-year rate has already risen from 0.3 to 1.1%. There is some chance it could rise even as high as 2% in 2021. Even the small rise we just saw caused almost all popular bond funds to decline in asset value by 1% to 2% in only a month. With low yields, a bond fund might only return 2 to 3% all year, and with rising rates, a decline could wipe out the entire year's return. When bondholders see higher inflation, they insist on higher interest rates on fixed income. Remember, one reason the Fed and politicians are pouring in stimulus is they are afraid of deflation due to businesses shutting down and high unemployment. If they see inflation, to some degree, they are happy and more comfortable with rates rising. The Fed has said that even if inflation goes above 2%, they will try to stimulate because they want to be sure that the economy is fully recovering. But once interest rates start rising with inflation, sometimes the Fed gets surprised. We could see 18 months or so of rising interest rate issues. And with rates at low levels, there's really only one likely long-term direction, up. It took nearly 40 years to go from 14% to under 1%. The lower income level from bond funds are already here. So we will be looking for ways to generate more income for a few years. On the other hand, after the recovery, the world will return to slower growth levels because of the aging populations and the impact of technology on labor. Unless wages start rising, we have time to gradually shift portfolios. We may need to cut core interest rate sensitive bond funds and international bond funds because they are expected to return only 1 to 2%, and they could decline in value if interest rates rise. We still want to avoid junk bonds or excessive credit risk. We have a series of additional videos planned to discuss the various strategies. Each client has a different sensitivity to taxes and a different time frame, and some solutions are limited to very large accounts. We can employ stock option collars on specific stocks, hedged equity funds, municipal bond ladder portfolios, bond funds with option strategies, convertibles, and preferred stocks. Some areas of real estate, including logistics centers, are doing very well and offer very attractive tax reduction. Unless wages start rising, we have time to gradually shift portfolios.
At HFA, investment grade and high quality bonds have always been the dominant fixed income investment vehicle. As you all know, one product does not fit all clients. Our advisors and planners will work closely with our clients to develop the correct fixed income strategy based on risk levels, income needs, liquidity concerns, tax consequences, asset values, and more.
Watch our upcoming videos on specific topics to help educate you on the alternatives to cash and bonds. Your advisor may be in touch to discuss this in additional detail. Be safe, and thank you for your time.